All right, we are off to the races again, betting on a Fed cut after that non-farm payrolls number. 30 minutes until it started trading. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, a cooling labor market. Jobs growth was far weaker than expected in August, reinforcing the case for a Fed cut later this month. And the trillion-dollar man, Tesla, offers an unprecedented pay package to Elon Musk that could make him the world's first trillionaire. And the AI chip race continues. Broadcom teams up with OpenAI to produce an accelerator that puts the heat on Nvidia. Dani, what are you watching?
Well, it's been a drama-filled morning, and it's only just 9 a.m. I am looking at that Broadcom story and the reaction in share prices, because check this out. 14.33% higher. That Broadcom deal with OpenAI puts it in direct competition with Nvidia, which dominates the AI semiconductor market. Broadcom also said its AI outlook will improve significantly. That helps ease concerns about slowing growth. Matt, what are you looking at this morning?
Yeah, I mean, that I think is fascinating. Broadcom should always have been included in the Magnificent Seven, the Great Eight. Tesla is another one. Elon Musk is being offered a compensation package valued at over $1 trillion if he meets certain benchmarks over the next 10 years. It includes growing the company's market value more than 8 times to $8.5 trillion. Dani?
Meanwhile, some data drama also adding to the market moves this morning. The Bureau of Labor Statistics warned that it was experiencing technical difficulties with its website just 30 minutes before that jobs report hit. Commerce Secretary Howard Lutnick spoke to Bloomberg about the issue.
So they need new leadership in BLS, that's for sure. They need new tech in BLS, that's for sure. And Donald Trump needs to rely upon the numbers. America needs to rely upon the numbers. You can't have these bent former administration people who have a view and who want to harm the president. We need accurate numbers coming from BLS, and finally we'll have new leadership to deliver it.
Well, we did end up getting the numbers, and it's a market that believes the numbers and is trading on them. Let's get over to Bloomberg's Michael McKee, international economics and policy correspondent. Mike, what did we get?
Well, we got a downside surprise, certainly, Dani. 22,000 jobs created in August, significantly lower than anticipated. We did see the July number revised up by 6,000 to 79,000, but look what happened when we got to June. The June revision put it in negative territory, down 13,000 on the month, which means it's the first month of job contraction since December of 2020. The unemployment rate came in at 4.324. If you take it out to 3 digits, that's almost a full percentage point above where it was in July. So that is a significant move on the month. The revisions, as I mentioned, show a negative print for June, and that may be what really is moving some of the markets in terms of the idea of a Fed rate cut, because they are expecting at this point that to drive the Fed to 25 basis points, and even some analysts are saying 50. I think that's probably a stretch, but it does suggest that the president's economic proposals are not panning out, at least in the short run. And we did hear him last night warn that we could have troubles. The biggest movers in the numbers were health and social services, which, as usual, is the largest gain, 46,000. Leisure and hospitality, 28,000. Retailing, 10,500, a bit of a surprise, although I guess we saw a reasonably strong back-to-school season from what the analysts are telling us. Manufacturing, the biggest loser, down 19,000 jobs. Again, reflecting poorly on the president's plan to bring back a lot of jobs to the United States. What really strikes as you look at all of these numbers is how many categories did lose jobs, but it wasn't a whole lot in each category. It's sort of like the beginning, perhaps, of layoffs, but 100 here, 100 there in most of these categories suggests that there is definitely weakness in the labor market.
So leaving aside the president's claim that this economy is hot, which he's been making based on his policy changes, what about his argument that we need to cut rates, Mike? Because you have unemployment rising, you have average hourly earnings that are not rising as quickly, and you have PPI and CPI at the core 3.7% and 3.1%. So does it make sense to cut rates here?
It does make sense because the Fed is looking at the labor market as a whole, and they're looking at the unemployment rate, which is their proxy for how the economy is doing. Go back to what we talked about a lot in the last couple of years, which was the SOM rule. If unemployment starts to go up, it starts to rise fairly rapidly. And as I mentioned, this was a fairly large increase in unemployment. So they are going to be worried that this trend will continue, especially with the ongoing uncertainty about tariffs and fiscal policy. And so it's definitely makes sense for the Fed to cut, and probably we will see an inflation increase next month. It's just not going to be large enough to throw people off the track.
All right, Mike, thanks so much for joining us. Bloomberg's Michael McKee there out of Washington on this jobs day. This afternoon, Chicago Fed President Austin Goolsbee will join Balance of Power. We'll get to hear his take on the NFP number and the rate situation. Let's turn, though, now to tech, because Tesla, the EV maker, has proposed a new pay package for the CEO, Elon Musk, worth around $1 trillion. Now, it does span 10 years and includes a series of benchmarks that Musk has to meet, including making a lot more money for his shareholders before he gets the full payout. So for more, we're joined by Bloomberg Tech co-host Ed Ludlow in San Francisco. And Ed, it's a striking number, but the benchmarks that he has to meet are also equally striking.
Yeah, the actual value of the award as it stands today is $88 billion. But over the 10-year period, if he hits those operational and financial milestones, the total value would be calculated to be around $1 trillion. There's some very heavy operational milestones. He needs to have sold 20 million Tesla vehicles, which is interesting in the context of the business model he has with Robotaxi. He has to sell or build 1 million Optimus robots, and there are market cap goals as well, taking Tesla's market cap to 8.5 trillion. There's also a consideration, Matt, which I know you took interest in, right, which is that in the latter part of the deal, the final 3 years, Musk has to participate in and align with the board on a succession plan. And he can only access tranches 11 and 12 of the comp if he does so. And that's really critical because he wants more voting power. And to get that upper level of voting power beyond 25%, that comes with tranches 11 and 12. So the detail of that in the proxy is really worth reading.
Ed, the other thing you pointed out, as soon as this proposed agreement came out, was the fact that they are asking Musk to wind down his political involvement. What is the language surrounding that? Yep,
Section A51 in the proxy. This board basically says this is what our conclusions were. They met with Musk 10 times in negotiation and consideration of this package. And point number 2 is that they want to seek reassurances, and one would assume that they have, that he will wind down his political ambitions. At the same time, there's a very heavy suggestion in the filing that Musk's retort to that was, okay, give me the voting power. And so that's why it's structured in tranches over 12 years, with each of those annualized milestones giving him an additional percentage of voting power. It's really interesting. It keeps him focused. Same with the succession plan participation from Musk. It's very heavily centered on the final 3 years of the deal.
All right, Ed, thank you very much. That's Ed Ludlow. And tune into Bloomberg Tech at 11 a.m. Eastern. Former Tesla board member Steve Wesley will be joining the show. Now, on the earnings front, also speaking of Bloomberg Tech, chipmaker Broadcom reported a strong outlook. Shares, though, they're moving mostly higher on the news that it will build a semiconductor for OpenAI, taking on the likes of Nvidia. Bloomberg Tech's other co-host, Caroline Hyde, joins us now around the desk. Caroline, just how big of a threat would this be to Nvidia? Is this really them taking on the giant?
Well, this is what we've seen with the other key hyperscalers. Look, Google designs its own chips with Broadcom. Meta's been in on the action. You've seen similar moves coming from Alphabet and indeed Amazon. All of the hyperscalers have decided that they need to have custom designed chips that aren't just totally dependent on Nvidia's supply chain. So yes, they look to Broadcom. Broadcom here really showing that their backlog is huge. They already have been talking up how much more business they're winning from the 3 key clients they already had. And now there's open secret. We all kind of knew OpenAI and Broadcom were working together. But now a $10 billion order, that just shows that the AI scale and the opportunity for Broadcom is going up and to the right, and particularly showing that growth, as Nvidia has perhaps been worrying investors with its growth plateauing a little bit. So more broadly, you are seeing Broadcom taking a bigger and bigger piece of that pie. Look, $10 billion is nothing to sniff at. And more broadly, we're seeing seeing already shares up 30% year to date for Broadcom. That's better than any of the other Mag 7 names.
Well, if this chip is going to be powerful enough to rival Blackwell, or even, what's the next gen called after that? There's another. Rubin. That raises, to me, the concern that Huawei or Chinese chip makers also could be on the same path.
It's interesting about how they are ultimately becoming more and more specific for individual clients. And this is where people start to think, okay, it's not just about training ever more impactful large language models. It's about the inference. It's about the use case. So this is why you want more specific chips designed for more specific customers. And maybe that's where people think, okay, is Nvidia still going to hold that chunk of change in inference as it has done in training? And that's something overall Jensen Huang has been trying to tell the market that yes, they can, and they are still the #1 compute member of choice. But I think people want choice, and you can't be so dependent on Nvidia. Broadcom here will be alongside Nvidia. I think you are seeing more and more of these companies having to deliver. You're right. Overall, people are wondering, how is China managing to evolve? How is Huawei? How is some of the other Capricorns starting to step up and make sure that China can be less dependent on Nvidia? It's exactly what you're seeing at home in the United States as well. But for most people, this is an and rather than or to Nvidia.
I think investors would also welcome a lessening of concentration risk. Caroline, thank you so much for joining us. That's Caroline Hyde. And of course, tune into Bloomberg Tech at 11 a.m. Matt, a quick check on futures, because we are trading at a record high at this moment after closing at a record high yesterday, but maybe more of the dramas in the front end. Yields on the 2-year yield down to the lowest since 2022. Gold is also at a record this morning.
Yeah, I think a lot of movement based on this number, and certainly traders are increasing their bets that the Fed is going to be able to cut. Maybe more and more. If you see this unemployment number continue to rise, that's a really worrying issue that even the hawks on the Fed are going to have to throw up their hands and make a move.
At 4.3%, the highest figure since 2021, but do cuts actually save that? Coming up, we're going to ask all these questions of one potential Fed chair. BlackRock CIO Rick Rieder, is the CIO of Global Fixed Income there. He has had his name floated as one of the likely candidates. We'll ask him about that as well. This is Bloomberg. Heading for a second day of a record close, this time thanks to rate cut bets, with the 3-month average of jobs added the lowest since the pandemic. The unemployment rate goes to 4.3%, the highest since 2021, and stock futures up 0.4% for the S&P. The 2-year yield down a whopping 12 basis points. That moves to the lowest since 2022. Let's get the reaction now of BlackRock Chief Investment Officer of Global Fixed Income. That's Rick Rieder. Rick, great to see you this morning. Just your initial reaction to the data just under an hour ago.
Yeah, I mean, listen, it's a pretty remarkable, I mean, I always focus on the industry data to try and get a sense for what is the fabric of what's happening here. So if you look at the numbers, so we got 22,000, but we talk about on the show all the time, 46,000 was in healthcare, not cyclical. You have a dynamic where if you strip out healthcare, you're running negative, what is that, negative 24,000 jobs. If you take the 3-month, 4-month moving average, we're looking at 29,000 jobs, with healthcare being 59,000. So if you strip that out and you look at what's happening to the broad economy, you have an economy that's actually doing well. You have a job market that's actually soft today. And, I think it's pretty remarkable. We talk to a lot of companies. You hear the same thing. Top line revenue's pretty good. Economy's okay, consumer's pretty good, but you're actually doing things with lower costs, with lower human involvement, which is a technology evolution of productivity, and you just see it play out. People think like it's going to happen 2 years from now. Listen, I think the labor market is soft, even though the economy is actually in pretty good shape, meaning the Fed's got to cut. And the Fed, I think the Fed could cut 50 basis points. I think they should cut 50. But I think the door's open, and how much more data? By the way, you saw it in the JOLTS report as well. You look at job openings, and the area that's held up the job market has been leisure, hospitality, healthcare, and you're seeing those areas soft now. So it's time to move.
Rick, I can understand maybe cutting some jobs, especially with the advent of AI. Hopefully, that's driving productivity. On the other hand, if the economy is growing, shouldn't employment growth be there as well? Shouldn't hours worked be moving higher?
So no, I don't think so. So you know what? If you look at one of the piece of data I love looking at. So the big 6 companies. So I take the Mag 7, you take out Tesla, and if you look at what's happening to their employment dynamic, those companies are throwing off. And by the way, we see it through earnings, we see it through capex and AI, and then you look at what's happening to their employment picture. They're actually, you see many of them actually cutting jobs. What's happening? You run a more efficient business, you drive higher free cash flow. By the way, you can buy back your stocks while these stocks continue to do well. The companies are doing fine, economy's doing fine. We're entering an era that's quite frankly very different than anything we've ever seen before. There's a substitution effect for lower skilled. By the way, when you break down the employment report and you look at lower skilled, some of the minority data around unemployment, you see some real dispersion, and it's part of why I think if you look at low middle income in this country, they're having a hard time. It's why, even though companies are doing well, even though the economy's doing well, even though wealthy are doing well, who, by the way, benefit from higher interest rates, you have a low to middle income part of the population, which, by the way, it's not like 4%, it's 50% of the population that's having a hard time today.
Rick, I guess the question with all of this is if on the headline level the issue are things like productivity, why would a 50 basis point cut help with that?
So there's a couple of things at play. First of all, if you take the starting point, Fed funds rate at 4 3/8, inflation expectations, so we follow 5-year inflation expectations, are about 2.5%. 4 3/8 is the wrong price. If you got the funds rate down to, let's say you got it to 3, 3.25, you're still above where inflation expectations are. There's no reason to keep it here. And I go back to this same point. If you think about what is your constituency that you're addressing when you're the central bank, if you think about what's happening, gosh, there's a little bit of inflation pressure from tariffs, which is goods inflation. Well, goods inflation tends to be a moderate regressive tax in terms of low income. Why would we charge them more for the interest rate? For whether it's home equity lines, whether it's for credit cards. Meaning if you bring that rate down, you won't stimulate more inflation necessarily. It's certainly not going to impact the tariff transmission mechanism. But you would help a lot of people in the country that are struggling today and are getting, a bit of a regressive tax from tariffs in the intermediate term or the short term. But you help them in terms of bring down their cost of borrowing.
Rick, I just can't help but wonder. I mean, we've heard the president argue that the reason rates should come down also is because the economy is doing well and things like the housing market. Are you saying that you agree with the president on that front? And if that's the case, what's the risk that the long end continues to rise and doesn't solve the problem that rate cuts are supposed to address?
So it's a great question. So the first thing I would say, the housing market is stuck. Whether it's building permits, mortgage applications, new home sales, housing starts, we're at levels in the 60s, similar to the 60s and 70s when the population is roughly double the size. Housing market is stuck. What does that mean? You create a dynamic in the economy where people, if you want job mobility in a tougher job market, it's harder to move because you can't sell your house, particularly if you have a 3% mortgage. We need to bring down housing costs. We need to bring down affordability of homes. By the way, I've argued this on this show many times. If through the funds rate mechanism, the mortgage rate comes down, and I'll get to the other part of your question. If you bring the mortgage rate down, you'll actually build more homes in this country so home builders don't have to subsidize the mortgage. You actually bring down shelter inflation, which has been sticky. Your point is well taken. Listen, as an investor, we like the front to the belly of the yield curve because you have, like today, could you have a steepening of the curve? Listen, there's a series of tools that the Treasury can implement, a series of tools that the Fed can implement to be thoughtful about how do you manage further out the yield curve as opposed to just we move the funds rate in moderate increments. There's a lot of tools at play to try and contain where the back-end interest rates are. I'm
going to say, Rick, that the administration and Scott Bessent specifically have been watching you on this program or maybe just reading your research, but they seem to want to interview you for the top spot at the Fed. Treasury Secretary Bessent has said he's going to start those interviews today. Are you going to Washington?
So I'm going to focus on the jobs report and what I do day in and day out to generate return for clients. I'm focused on what I do day in and day out, and I'm not. I'd rather not comment on that.
I'm sure that that's a focus for you, but if your country calls for your service, how do you answer, Rick Rieder?
How do I answer? So I'm going to focus on. I'm just not going to answer that. I'm focused on what I'm doing day in and day out. And listen, whoever ends up being chosen, and I've seen some very good commentary from some of the candidates that are out there. Whoever's chosen, there's a big discussion about Fed independence, and I'm a devout believer in Fed independence and what it does for currency stability, what it does for how people around the world think about investing in the U.S. I also think there's innovation and creativity and some thoughtful dynamics that I think the Fed can bring to the equation. Whoever that is, and I think there's a bunch of good candidates on that list, I think we're going to move to it in a direction that we'll see some more innovation, which I think makes some sense.
Rick, I'm just going to say Chair Rieder has a wonderful ring to it, and I will leave it there. Rick Rieder, thank you so much. You're going to stick around with us, and we're going to get more of the market action after the opening bell, so don't go anywhere. Still ahead, Labor Secretary Lori Chavez-DeRemer joins us live from the White House as Kevin Hassett says that the jobs number will be revised up by almost 70,000 jobs. We'll have more on that, too. You're watching Bloomberg Open Interest. The 3-month average for jobs growth, 29,000. That's the lowest since the pandemic. The market reaction is one to rally. We're off of the highs, Matt, but we are still on track to close at a record with 2-year yields dropping to the lowest since 2022.
Yeah, absolutely. It's important to point out that the director of the NEC, Kevin Hassett, does say that these numbers will be revised up by 70,000 eventually, and that doesn't seem to be taking too much wind out of the sails of a bet, the market firmly placing bets that a rate cut will come in September. More next with BlackRock's Rick Rieder plus Labor Secretary Lori Chavez-DeRemer. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We had a very weak jobs number, less than a third of what we expected. And as a result, markets are rallying because they're betting on a rate cut. Odds on WIRP are over 111% right now. NASDAQ futures up 0.8% as the Broadcom and Tesla stories help to rally the market as well. The small caps, of course, gaining 0.5%. They need a rate cut more than anybody. On the New York Stock Exchange, you've got Elf Beauty, and they are happy for a reason. The stock is up 600% in the past 5 years. And
Haley Bieber
wait,
there.
Haley Bieber is...
Yeah. The woman, Haley Bieber with the glasses. I think that's Haley Bieber in the front
Here,
row.
okay. Apparently that's Haley Bieber. It does look like a small tattoo on her neck, so I would guess that's a Bieber-ish thing to have. BCP Investment Corporation ringing the bell at NASDAQ, also plentiful and smiling, even though their stock is down 16-17% year to date. Apparently, they're doing some kind of rebranding after a little bit of M&A. So I'll look at that stock. I'll check back and see if it helps them to rally up to at least unchanged.
That would be lovely. And
Yeah.
Matt, I have one stock that is decisively higher for us to watch this morning, and that is chipmaker Broadcom, up just under 15%. It's going to help OpenAI create a chip available in 2026, and that puts it in direct competition with Nvidia. Broadcom also said its AI outlook will improve significantly, all of that helping to ease concerns about slowing growth, Matt.
All right, so Avgo on the run this morning. Tesla also rising. Stakeholders are offering Elon Musk a compensation package, or I should say the board offering Elon Musk a compensation package valued at $1 trillion, but there are some big ifs attached to that package over the next 10 years. It includes growing the company's market value to at least $8.5 trillion. So they would have to, he would have to raise the market value of Tesla by more than 8 times. We're back with BlackRock Chief Investment Officer of Global Fixed Income, Rick Rieder. And Rick, I want to get your take on these Kevin Hassett headlines that the jobs number will be revised up by 70,000. I know we've seen revisions very often to the downside. That's one of the reasons the president fired the chief statistician. Does this number look surprisingly low to you at 22,000? Do you think it should be more in the 90s?
No, not necessarily. I mean, listen, I think that, you think about the size of the economy, just think about the size of the population. I mean, we're talking, if you take a step back and you talk about the size of these numbers and the delta, what it means, it's actually, they're not that large that you could have these revisions up and down around the mean. I think the thing that we focus on, is what is your moving average and where are we? What's your 3 months? What's your 6 months? What's a trend look like? And the trend, by the way, we talk about it's a good economy. It's a really solid economy. The trend is a bit lower. I think one thing that you have to also reflect within these numbers is immigration has come down significantly. That was literally 100% of the supply of labor, what created in places like leisure and hospitality created a huge amount. So to see some diminution of hiring on the backside of that too, that's something you also factor in the equation. So, listen, I think what we're talking about is a moderate, an economy. By the way, it's not laying off a lot of people, but it's just the velocity of hiring is slow today.
Rick, though, I think part of what Matt's question also gets at is this isn't just a random market commentator, right? This is the director of the National Economic Council. If you have administration officials saying, don't believe the number, it's actually higher than it is. This is the first data point. We should also say, without the head of the BLS, does that concern you at all? Does it concern you either about the reliability of the numbers or about this market's willingness, getting back to our early conversation, to continue to fund deficits if there are questions about institutions in America?
So, listen, I will say one thing. I've been doing this a really long time. You think about we're in the era of big data. I still am blown away that the markets focus on that one release, whether it's CPI, whether it's payrolls. So what do we do? What are we trying to do within our business? You can scrape the internet for data, credit card data, hiring data, et cetera. You can do some pretty incredible things around earnings reports. And so what we tend to do is you take the whole combination. You think about for years analyzing the data in places like China. You have to go and look at what are your other sources, power, what's happening to the power supply, what's happening to different parts of the economy. So, listen, what we try and do to evaluate is just think about the broad landscape. Listen, I think the data is, the data that's always been released, including surveys. I never understand why the markets focus so much on surveys. What we try and do is we use a ton of signaling data, AI data related help to do this, to try and understand what's the broad landscape look like. And you generally get a pretty clear picture when you take a lot of factors in the equation.
I thought it was interesting, Rick, I was listening to Tom Keene and Paul Sweeney on surveillance this morning with Ken Rogoff, and he was talking about the importance of the non-farm payrolls number. I've always called it the granddaddy of economic statistics. Listen to what he had to say.
Jobs Day has always been the big number because it's the most reliable number that we get sort of in real time. Maybe now and going forward, it's not going to be considered as reliable, and I don't know what we're going to look at.
So Ken Rogoff of Harvard fame, if you still trust that institution, and also the author of the new book, Our Dollar, Your Problem, which is on Tom's summer reading list, I think #1 rec. Rick, what do you think about that? Are we getting to a point where we can't trust our institutions?
So, I don't know. You could take a pretty cynical. By the way, I agree he's a very smart guy. I would take a couple of things into the equation. Yes, the payroll report. I've been doing, I don't know how many years. I actually calculated how many payroll reports where my heartbeat goes up and my blood pressure surges. It is the big number that we focus on. But like I say, I still, if you take a step back and think about, do we trust our institutions? Yes. Do you like living in the United States and think about how our ecosystem works that allows us, to tap into different sources and look at different pieces of data? So I don't know. I'm not that skeptical on it, but listen, do you want to see good data? And what he says is right. Payroll report's a really good one. By the way, claims data is pretty good. The JOLTS data is pretty good. Listen, so we got to pull it all together and try and get what the broad fabric looks like.
Rick, while this is going on, we're also in the midst of Stephen Myron's confirmation hearing to join the Fed. A watcher writes in wanting to know your opinion on Myron yesterday, saying that part of the Fed's mandate is to have moderate long rates. What do you think that exactly entails? Is this a Fed that potentially, with more choices coming from the Trump administration, would do something like an Operation Twist, would buy long rates if they back up? What would that mean to have moderate long rates?
So, listen, I think there's a series of tools. The Fed has balance sheet, they have morals, they have suasion, they have a whole series of things that they can do in terms to effectuate where the curve is. By the way, I've always been blown away by how actually, just by talking, how you can influence where market pricing is according to what your forward opinion is going to be where you're going to move things. So there's a series of things that you could do. And quite frankly, I think, part of why I said, you have some innovation at the Fed. If you go back to post-COVID, the Fed was incredibly innovative and thoughtful about different asset classes, about how they thought about balance sheet, where they utilized it, et cetera. And so, I think the idea that, could the Fed employ more tools? Think about how we finance today and think about the growth of private credit. How do we finance real estate, commercial, resi, asset backs, cash flowing entities? The world of modern finance has just exploded in terms of tools, utilizations, parts of the cap structure. To think that moving the Fed funds rate at the front, the overnight funds rate 25 basis points at every meeting, it's just hard to believe that's the most creative thing we could do today.
Hey, Rick, really thoughtful as always. So good to get your thoughts. We covered a lot of ground. That is BlackRock's Rick Rieder. Thank you so much. And look, there are still lingering questions about the data, Matt, and about the White House. Kevin Hassett, as you mentioned, saying 70,000 jobs would be added. We were hoping to speak with the Labor Secretary, Chavez de Reimer, about this. Unfortunately, she is no longer joining this program. I think I can speak for both of us when I say the Secretary is absolutely invited and welcome to join this program whenever she can.
Yeah, absolutely. And there's a lot to ask her about as well after the ProPublica report yesterday that suggested she has 2 mortgages listed as her primary residence, that she claimed primary residence for 2 mortgages that were 2 months apart. If that's the case, you wonder not only what she thinks about this jobs report, but whether or not she feels she needs to resign, because as we know, President Trump's administration has said that can't be tolerated. No matter who you are, they consider that to be breaking the law. Certainly Bill Pulte has tweeted as much. Yeah. And no one, as he said, is above the law. And that would include, you'd guess, if it's true, Lori Chavez de Reimer, this according to ProPublica.
And a spokesperson did respond to ProPublica saying that it was her husband that had planned to retire there. But I guess what you're getting at, Matt, is this issue where it sounds like one rule for allies, another for enemies. We give her the benefit of the doubt. Should Lisa Cook then get the benefit of the doubt as well? So again, a lot of lingering questions, and we invite the Secretary to come join us when she can. All right, Matt, shall we get a check on markets this morning?
Let's take a look at markets now after that jobs number came in so weak, but then the administration said it's actually stronger than expectations. We had a gain and still have big gains, 0.4%, a gain of 26 points on the S&P 500. Does that push us to a new record?
It would indeed, Matt, because we were at a record yesterday, so we don't really need to move that much to that upside to get that new record. So if you look at what's driving us there, it's the 2 stories we've been talking about all morning, right? It is Broadcom and it is Tesla. For Broadcom, it's developing chips for OpenAI. For Tesla, $1 trillion pay package for Elon Musk, the first $1 trillion man. Maybe he can help pay down some of the American deficit. Moving us lower is Nvidia, maybe also reacting to that Broadcom news because they have a serious challenge now in the face of that. Microsoft also moves to the downside. Let's just get a check on the sectors too. Again, about 10 minutes into your trading day, and only one sector into the red, and it is energy, with some headlines about maybe Saudi wanting to pump out more oil in the OPEC Plus decision. We're going to get that this weekend. Otherwise, everything is in the green, and it's the interest rate sensitive sectors. No wonder, because we are now implying that we will get that 100% plus odds that we will get a cut. So real estate does well, materials, consumer discretionary, Matt. Again, everything positive for a total return so far this morning of 0.4%.
Yeah, I think fascinating that you have Nvidia down 2.33% because it's such a heavy stock, right? It's worth 7.5% almost of the S&P 500, but Broadcom is worth 3%. So you could see that a 15% gain doesn't hurt much at all for that stock. Coming up, Lululemon slashing its outlook, disappointing investors for a 3rd straight quarter. More on the yoga pants retailer next. This is Open Interest.
Time now for some top calls, some of the analyst action in focus this morning. First up, UBS has downgraded JB Hunt to neutral, suggesting that an inflection point in truckload prices seems unlikely in the near term, but it is rallying with everything else this morning. Next up, Baird initiating coverage of TKO Group with an outperform rating, saying it's well positioned at the intersection of key themes in the media landscape. Those shares up 2.33%. Finally, Stifel downgrading Lululemon to hold after its earnings, highlighting challenges from tougher trade policy and cautious U.S. consumers. Now, Lululemon CEO says, quote, "We're seeing fatigue with the consumer, particularly our high-value consumer who's been with us for longer." For more, we are joined by Bloomberg Intelligence senior retail analyst Poonam Goyal. And Poonam, Lululemon shares getting absolutely destroyed in today's trade. Is this about a macro influence of weaker consumers, or is this just about the competition eating Lululemon's lunch?
It's about both and execution. I think execution is really key here. When you look at what's going on with the numbers and why the guidance was cut so much, it's because they don't have enough newness in stores. They're not moving as fast as customers would like. They really need to step up on that. And they say they're planning to, but it's not going to be till spring 2026 that we can see consistent newness at a high level.
Isn't this just how it goes, Poonam, when you're talking about fashion at this level? I mean, how long, even if, this company was a pioneer in getting women to wear yoga pants in public, how long can they dominate in this, category that they created?
They're still dominating. I mean, clearly there's more competition, but if you heard them closely, they said the performance business actually did well. It's the casual side of the business, which is about 40% of the mix, that is struggling. And that's where they need to really step up on innovation. Their Align, No-Line pants were a call out in the quarter. They've done really well. But when you listen to Scuba and you listen to SoftStream and Dance Studio, these are some of their casual lines. They just haven't been performing. It seems like what you see there is what you see everywhere, and that's not what consumers want to see. They want to see new things from Lululemon. They want to see innovation.
Poonam, if you live in New York City, you've been inundated with all things U.S. Open, and it feels like U.S. Open things have gone hand in hand with Lululemon. Lululemon seems to be putting a lot of dollars into marketing. I think they sponsor TFO. They've had this pop-up at the U.S. Open itself. Yeah. Is this the route forward for Lululemon to try to grab onto some of this viral marketing, or is that not enough? Is it the innovation piece that you're talking about?
I think they have to do both, right? So you need to be where the customer is. You need to be on social. You need to do pop-ups. You have to be at these sporting events. That's table stakes today. That said, it won't increase their marketing spend. They said that they're going to hold their marketing spend at 5% of sales. And then on product is still king in retail, in any retail. You have to have the right product to get customers in your door and shop.
All right, so the stock has been massively underperforming. If I look at a 5-year chart, it's down more than 50%. How much do you think with the right moves, Poonam, this company can recover?
I think if they can get the assortment right and the customer back in the door in 2026, they will stand to recover from what they're seeing. That said, there are still tariff headwinds, right? Much of the cut in the guidance that you saw yesterday was because of tariffs. They took their gross margin guidance down by 300 basis points, and that was 190 basis points more than they previously expected, largely due to the de minimis exemption that was taken away.
All right, Poonam, thanks so much for joining us. Poonam Goyal there, Bloomberg Intelligence, talking to us about Lulu as well as the state of the consumer and tariffs. Coming up, investors are piling into gold ETFs as the shiny metal hits a record high. That's next. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on what's going on in stocks at this hour. Right now, another record all-time high on the S&P 500, 6530 there as the index rises more than 0.4%. Broadcom part of that story. Let me show you the stock in just a second. NASDAQ up almost 1%, so 0.9 to 23,840. The small caps gaining more than 1% as well, as everyone is betting on a rate cut September 17. Now the question is 25 or 50 after that non-farm payrolls number that we saw showing only 22,000 jobs were added in the month. Although the administration says it's really more like 92,000. Actually, can't trust that data. Nvidia right now down almost 2%, and typically that would be enough to drag the S&P to losses. But because Broadcom is up 12 or 13%. It's adding back most of that difference. Nvidia worth 7.5% of the S&P 500. Broadcom worth 3%. Tesla gaining after the board approves $1 trillion pay package for Elon Musk. Google is up as well. Gold at an all-time high, and I think it's the 7th all-time high this month. $35.93, the level there for Troy ounce, and the Spider Gold Trust gaining. Obviously, when gold rises, you want to jump into that too, right?
Yeah, and I just love the irony of stocks at an all-time high and gold at an all-time high. I think that tells you something there. And as you point out, Matt, investors have been piling into gold ETFs more than any other asset class this week, with that precious metal hitting another record. Bloomberg Intelligence ETF analyst and ETF IQ co-host Eric Balchunas joins us. Eric, if you look at the demand for gold between central banks, between, I don't know, our parents going out to Costco and buying gold bars, and the ETFs, how much are the ETFs contributing to the record rise we're seeing in the spot gold price?
Yeah, they're a factor. You know, people, I think, overrate the ETF's impact because if you take all the gold above ground, ETFs own like 1 to 2% of it. So there's a lot more going on. That said, ETFs are the fastest thing, the first thing people reach for. They're very accessible. So ETFs give us a good sense of sentiment. And we've got $44 billion into gold ETFs worldwide. About $24 billion of that's in the U.S. So international also, this is a global trade right now. We think the big trade this year is to keep buying stocks, but you buy gold and maybe a little cash just to make yourself be able to sleep at night, given some of the geopolitical uncertainty, the administration. So gold and stocks rallying at the same time was the trade all year. And anybody who's been buying both is thrilled with the jobs report because it means Fed rate cuts, which is usually good for gold and stocks.
I wonder why, though, we have the big gains in gold, even though you mentioned the geopolitical uncertainty, even though we know this administration loves gold, at least as a decoration. Isn't it normally supposed to be a hedge against inflation? And if you don't think that we're going to see inflation, why would you buy gold?
Yeah, you know, gold's track record as being a hedge against inflation is a little shaky. I personally think a lot of people were buying it as a diversifier. You know, just in case the tariffs were worse than we thought, just in case World War III broke out. Like, I just think it was the hedge you bought while you kept buying stocks. And this is something we've seen in the past. We saw a little bit of this in 2020 as well. In fact, that was the record year for gold flows was in 2020, 34 billion US. So we're at 24 billion US, 10 billion away from breaking the 2020 record. We'll see if it gets there. But that's what I think it's for. It's more of a diversifier. It's not even a great stock hedge. It's zero correlated, and I think it does its job. And this year, like I said, if stocks go up and gold goes up, that's obviously positively correlated. So it's a very interesting asset, in my opinion, and I think people use it mostly just to diversify.
All right, Eric, thanks very much. Eric Balchunas there. And your ETF expert. I think he's everyone's ETF
Literally the world's ETF expert.
This guy knows more about ETFs than anybody in the world. And that's why he co-hosts our ETF show. Bloomberg ETF IQ, you can see it every Monday at noon New York time, 5 p.m. in London. It's one that you don't want to miss.
Yeah, because the money is flowing into that gold ETF, and I wonder how much of that is also just not flowing into bond ETFs. He's talking about it being the hedge for stocks because treasuries haven't been working as the hedge for stocks. Just the volatility there, but I should say that with this move this week, you actually have yields much lower on the week, significantly lower at the front end, the lowest since 2022 after that board data.
I should point out, Bitcoin is rallying today as well. Digital gold is up 2.5% to $113,000. So that line of code is also incredibly valuable.
Yeah, but my parents aren't going to Costco to buy Bitcoin.
No,
so just
they buy it on the app, right?
Yeah, of course. Yeah, my parents absolutely are doing that.
Coming up, we'll talk to former Fed economist Julia Coronado, get her take on this jobs number. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Stocks headed for a second day of a record high as rates collapse on the front end and throughout the curve after much weaker economic data. Coming up, we're going to talk about just that, a cooling labor market. Jobs growth was far weaker than estimated in August, reinforcing the case for a Fed cut later this month.
And the trillion-dollar man, Tesla offers an unprecedented pay package to Elon Musk that would make him the world's first trillionaire, but not for like over a decade.
Yeah, it's still a trillion, even in a decade. And chip tariffs are coming. President Trump says that he will be imposing fairly substantial tariffs on semiconductor imports soon.
All right, we'll bring you that news as soon as it crosses. We begin with the jobs report, though. BlackRock CIO of Global Fixed Income, Rick Rieder, said the economy is still in good shape despite the weak data.
You have a dynamic where if you strip out healthcare, you're running negative, what is that, negative 24,000 jobs. If you take the 3-month, 4-month moving average, we're looking at 29,000 jobs with healthcare being 59,000. So if you strip that out and you look at what's happening to the broad economy, you have an economy that's, you have an economy that's actually doing well. You have a job market that's actually soft today.
Let's get more on the jobs data with Michael McKee, Bloomberg's international economics and policy correspondent. Mike, you heard from Rick Rieder there saying that this economy is fine. It's just a soft jobs market. You've had an hour and a half to comb through the data. Just how soft or weak and consequential was it for this economy?
Well, I think what we might be seeing, Dani, is something of a turning point or an inflection point for the economy. Whether it continues down this path, we don't know. You're going to have to wait another month, perhaps, to get a third month in a row of poor labor statistics. But it certainly does show that the economy has slowed. Now, the consumer has continued to keep spending at a slower pace, but they haven't seized up yet. And business spending was up in recent months. So it is hard to say that this is an economy falling off the cliff. Maybe it just needs a little goose from the Fed. We'll see. 25 basis point cut isn't going to do much very quickly. But obviously, there's a problem here, whether it's a serious problem or whether it will be, we'll see a rebound, as Rick was suggesting, is something that we don't know and the Fed doesn't know yet.
I wonder, to that point, what you think about Kevin Hassett's comments. Kevin Hassett, of course, is the director of the NEC. He of the previously of the Milken Institute, of the AEI, of the Hoover Institution. He said that the jobs number will be revised 70,000 higher from here. So essentially, the view from the White House is that this report is wrong, right?
I don't know if they think the report is wrong. They haven't come out and put the kind of negative spin on it that they did last month when we had such a big negative revision. Even
the Labor Secretary, Mike, to that point, the Labor Secretary didn't even come on to give us her spin. We had her scheduled for an interview that the White House canceled last night.
Well, that is also probably due to the fact that, as you've been talking about, ProPublica mentioned her in connection with mortgage problems along the line of Lisa Cook, so maybe she didn't want to answer questions on that. But to Hassett's point, what he's doing, and he would certainly, I'm sure, agree with me, is talking his book. He is in the administration. He has to make it look good. And in the past, he's taking an average of August revisions. Now, we have seen revisions significantly sort of change since the pandemic. And for the last couple of years, in general, what we've seen are revisions downward. So it's certainly possible that they get revised up, and it's certainly possible there are seasonal issues with this. But I think the 70,000 number is just sort of a past average. It's not an actual prediction by Kevin, and I don't think anybody would make a strong prediction on what the revisions are going to be.
All right. It's good to have Mike McKee here to set me straight once. I have Dani now to set me straight, which is like her new role.
Mike, I'll help you along here.
Mike McKee there in Washington, D.C., our international, our global policy and economics correspondent. Later today, by the way, Mike McKee is going to speak with Austin Goolsbee, Chicago Fed president, on balance of power. That is an interview you do not want to miss at 1:30 p.m. New York time. I will be listening to it on Bloomberg Radio.
Yeah, as will I. It would be a good interview.
Yeah. All right. Joining us now is Julia Coronado, a former Fed economist who runs MacroPolicy Perspectives out of Austin now. And Julia, just first off, let me get your reaction to the jobs number. As Dani pointed out, it's dragged the 3-month average down to 29,000. That's the lowest since the pandemic.
That's right. I mean, it's difficult to put lipstick on this pig. It is a weak jobs report. Last month was a weak jobs report. More and more sectors are shedding jobs on balance, not adding jobs. The pillars of job creation, state and local governments, private education and healthcare are slipping. So this looks like a labor market that is feeling the strain, not just of the trade war, but immigration policy has meant that now construction is showing job losses instead of being a source of job gains, as it has been in recent years. And again, these budget cuts are what are hitting the healthcare and state and local government sectors. So with nothing to replace it as an engine. So it really is a very weak picture. It looks like we are, to me, like we're close to a tipping point. We can talk revisions and technicalities, but I think the bigger picture is, we've put a lot of disruptive policies into place and offset it with a small-ish tax cut. Meanwhile, the tax hike of tariffs continues to, take money out of the economy month after month. And we're starting to see it filter into the macro data, and we're probably just at the beginning stages of this. So we're going to see tariffs push up inflation. We're seeing all of this take a toll on job growth. This is an economy that's being pushed to the edge.
Is it an economy that needs a 50 basis point cut in September, Julia?
See, this is the tricky part for the Fed. I don't think this is a 50 basis point cut report because the unemployment rate only ticked up a tenth. Policies like restrictive immigration are viewed by the Fed as structural, not cyclical. You're simply choosing a lower potential growth rate by having less labor supply, and that complicates the picture. So I don't think, especially with the surge in inflation that we're expecting to see in the CPI next week, I think they really are in a tough spot. Definitely a 25 basis point with a lean towards more should the labor market continue to be weak. But there may be dissents in favor of a 50 basis point cut.
Where should we be, Julia? What's our star right now?
Our star is really difficult to gauge. We've got this strange dichotomy of a stock market. I mean, for a macroeconomist to watch a stock market rally off of this report, it's just not the way I construct the engine of growth. The engine of growth is paychecks to consumers who spend the money, who then justify the AI investments and all of the other optimism that the stock market seems to reflect. You need consumers having paychecks to demand those services. So I don't know. It's a strange combination of easy financial conditions and a job market that's sputtering, and it looks very vulnerable. So where should they be? What is our star? We're in the middle of so much disruption that thinking about equilibrium is challenging. And what the Fed is facing, and we have seen it before. We were there in the 70s where we actually saw weak labor market and sticky high inflation. We've had that experience before. So that's why we're seeing some of this hesitancy on the Fed to be preemptive and get ahead of the curve, especially when, again, between aging and immigration, we know that the break-even rate on payrolls is probably not far above zero right now. And that just is what it is. The Fed's not going to change that with interest rate cuts.
Julia, this data was kind of interesting when it came to that, though. Yes, reduced immigration obviously playing a big role, but the labor force outright grew in this latest report. There was no supply shrinkage. What did you make of that?
Well, the household survey, is very noisy from month to month. So we saw the labor force participation rate decline over the last 3 months. We had actually penciled in a rebound this month, which is what we saw, partly just reflecting statistical noise. It bounces around from month to month. If you get a positive one month, you get a negative the next month and vice versa. So I try not to read too much from month to month moves in the household flows. The sort of rule of thumb for economists from the household survey is look at the ratios, not the flows. Look at the unemployment rate. Look at the labor force participation rate and the trends. So I don't put too much weight on that. It is something that on balance is going to be a constraint, labor supply. We're not going to capture that in real time in the household survey in terms of the flows, but the unemployment rate should kind of give us the overall correct picture of slack in the economy. And it's not huge. It's not widening. The SOM rule is not anywhere close to the 50 basis point threshold. So it's just kind of creeping higher. And then all the structural elements tell us that, growth, we're just not going to see that much growth in the U.S. If you don't have labor supply, you don't have growth.
By the way, you talk about the labor supply, the growth engine, and if I look at earnings for the S&P 500, growth was strong. I mean, double digits by some estimates in the last quarter. Is that set to slow down, you think, substantially, Julia, corporate earnings over the next few quarters?
Well, yeah, I think we did get some tax cut benefit to margins and to, earnings in this quarter, in this most recent earnings season.
But also
so I think
tariff hits to margins, right?
Right, exactly. So we've got these offsetting forces. The tax cut helped kind of get us through a quarter. I don't think it's enough to be the engine of growth. So yeah, I think there's some optimism built into those earnings projections. And even when you look at something like like a Home Depot earnings where they were saying, yeah, consumers came back, but they're still super cautious, not doing big projects, not wanting to borrow to fund bigger projects. That feels like, okay, there's a bounce. Consumers had to do some spending, but we're still in the same place of elevated uncertainty, lots of hits to growth. Again, the DOGE cuts are just starting to show through in the data as a weak hiring season for state and local governments and private education workers. That's not going to change next month. It's going to continue to be weak. And that has been an engine of jobs growth. So those people who are losing jobs or whose spouses are losing jobs are going to become more cautious. They're going to go into the holiday season with a great deal of caution. And we should see that in the consumer spending numbers in coming months. So I don't see the offset here to that. I don't see the engine of growth. A corporate tax cut is not an engine of growth. It is not leading to hiring. It is leading to protection of margins, which is fine for a quarter, but it's not going to drive the top line revenue gains that you need to see for it to be sustainable.
To your point, Julia, that idea of an economy that is at the precipice of change. Julia Coronado, thank you so much for joining us, former Fed economist and president and founder of MacroPolicy Perspectives. Let's get a look, though, quickly at some of the stocks that are moving at this hour. With that is Bloomberg's Natalia Kenijevic. Hey, Natalia.
Hi, Dani. So I'm looking at shares of Lululemon. They are down by 15% and now trading at the lowest level since March 2020. So the company downgraded its earnings guidance for the full year. Definitely the retailer is facing an increased pressure from both tariffs and slowdown in sales. It said it would take about $240 million hit from tariffs and the end of the de minimis exemption. We saw at least 5 analysts downgraded the stock today. Then in the tech space, I'm watching shares of Broadcom. They are up by 10% today. The company said it's helping OpenAI to design and produce its artificial intelligence accelerator from 2026. It also said that its artificial intelligence outlook will improve significantly in the fiscal 2026. JP Morgan analysts are saying that strong performance puts Broadcom on track to drive about $20 billion in revenue from AI in full year of 2025. And then finally, in the healthcare space, I'm watching Novo Nordisk and Eli Lilly. Shares are down despite the news that the WHO, the World Health Organization, added Ozempic and Mounjaro to its list of essential medicines that could expand access to drugs around the world. And the WHO also said that generic competition will be encouraged to drive the price of those drugs down.
All right, Natalia, thanks very much. Natalia Kenijevic there talking us through some of the stocks that are moving at this hour. Coming up, Tesla CEO Elon Musk could be on his way to becoming the world's first trillionaire, but it's going to take more than a decade and a lot of success. We'll discuss his new pay package proposal next. This is Bloomberg Open Interest. All right, the S&P 500 has turned negative just after our conversation with Julia Coronado from MacroPolicy Perspectives, where she said she doesn't understand why stocks would rally on this jobs number. It was only 22,000 for the month. It averaged only 29,000 over the last 3 months, and that's the lowest 3-month run that we've had since the pandemic. As a result, stocks were initially up because we were fully pricing in and still are fully pricing in one rate cut. However, maybe it's for the wrong reasons. Right now, it looks like that's what stock investors have decided, right?
Yeah, that's the thing, right? If we are getting a rate cut because unemployment's at 4.3%, the worst 3-month growth since the pandemic, it's the wrong reason. I would point out we're also getting a post from the president on Truth Social saying that Powell should have lowered rates a long time ago. But again, Matt, I think your point very much so stands. These are cuts for the wrong reason, especially if we're talking about 50 basis points.
Yeah, and we heard that, well, we saw a statement from Lori Chavez DeRemer. She had been scheduled to come on this program. She, through the White House, did cancel that interview last night, right after the ProPublica report came out, showing that she also, or alleging that she also has claimed 2 mortgages as a primary residence, which we now know you're definitely not allowed to do in the eyes of the administration. Nonetheless, she put out a statement saying, second quarter GDP smashed many economists' expectations, demonstrating strong growth and resilience. All job growth this year has been in the private sector among native-born Americans, making sure that no one who immigrated to this country, even fairly, is part of that statistic. And she does make sure, of course, to thank the president a number of times in her statement.
And, you know, I think that statement's also interesting is because nowhere in it does she say that the data is wrong. Nowhere in it does she say that you can't trust what the BLS is saying, even though Kevin Hassett was on media earlier, I believe, speaking to CNBC, saying that he thinks the numbers will be revised up 70,000. So it depends, I guess, what data as to the ones you can rely on.
All right, so that's one of the big stories today. There are many, you know, internationally. If you look at the collapse of, well, it's not collapsed yet, the crumbling UK government was an interesting story this morning. The Broadcom news is amazing. They're going to maybe in the markets giving them some credit for challenging Nvidia. And then this, Tesla's board has proposed a new pay package for CEO Elon Musk worth about $1 trillion. The plan spans 10 years and includes a series of really difficult benchmarks for Musk to meet to earn the full payout, but it is still massive. Let's talk to Steve Mann right now, Global Lead Director for Auto and Industrial Market Research at Bloomberg Intelligence. And Steve, the shares are up, so, you know, shareholders, they are, you know, part of what is sometimes a fanboy cult for Elon Musk. Is this because they believe he's going to be able to achieve it?
Well, I mean, the stock is up, but you know, if you compare it to their peer group, it's not up that much. I think investors are cautious. This is only a plan; it hasn't been passed yet. So we'll see what happens on September 15th when at the board meeting. But look, I think the overall thing here is that you know, it's a lot of money, but it's not that easy to get to. Some of the operational metrics that it needs to meet. It's very, very demanding. So look, it's a great plan. I think it's not going to be easy for Elon Musk to get there, and I think the investor can see that. Look, you know, it's going to take a decade, and some of these operating metrics are very, very high.
Steve, I'm like so for this. More companies should do this thing. Set an impossible metric and just make the CEO shoot for the stars and see what happens. But if we just look at the numbers itself, $8.5 trillion is where they want Musk to grow the valuation of this company within 10 years. That would be twice the valuation of Nvidia. What would Musk and Tesla have to actually do to get a valuation of that level?
Yeah, they can't make it easy for Elon Musk. If it's too easy, I don't think the investors shareholders are gonna pass that. So they're gonna make it a little bit challenging for him. You know, I think some of the highlights of those operational metrics is like the 20 million vehicles that they need to deliver between now and 2030. That's easily achievable. They're delivering around 1.8 million annually today, so it's not that hard to get to. I think what's really difficult, will be challenging, is the FSD subscription. So they're looking for about 50% take rate on FSD. Currently, it's less than 10%. It's probably around 5 to 6% right now. And then lastly, the EBITDA, adjusted EBITDA, metric of $400 billion annually, annual run rate of $400 billion. That's really hard to achieve because, based on our forecast, you basically need to hit over $1 trillion revenue for the company, and that's about probably close to 8 times where it is today. So not easily achieved. But look, in the last pay package that he received, those were stretch goals too, and he was able to do it. So it really comes down to execution and how he's going to get there. I
mean, Lord knows what kind of inflation rate we're going to see over the next 10 years. Maybe it's not that difficult to achieve, an octupling of the market cap. But Steve, it's weird for me to hear you talking about cars in this regard. I know you cover automakers for Bloomberg Intelligence, and you and I often have great side chats about cars. But this is, at least according to Elon Musk, not a car story. It's a robot story, right? He came out recently and said Optimus will be 80% of Tesla's valuation. So what do you make of that? And how weird is that for your job?
Yeah, that's a good point. I think they're all integral. One of the things that, first of all, it's probably not going to be an auto company down the road, given that the easy targets that he's getting for car delivery. The challenging part is the AI stuff, the FSD. The Optimus robot, he needs to deliver 1 million. And I think that's going to be really hard to deliver 1 million unless he's going to use a lot of them in his factories. Then he'll be able to deliver 1 million.
Hey,
so
Steve, just quickly, tough. If I can jump in, because one of the other things we wanted to get your take on was in this proxy statement, they also talked about this idea that he needs to have assurances that Musk's involvement with the political sphere would wind down in a timely manner. What did you make of the inclusion of that in the proxy?
Yeah, I'm not surprised that's it's included in that, and I think the board is suggesting an against vote on that. I think he's already doing that. We haven't heard a lot from him on the politics, and I think in the past few months with his focus on the company and his other companies, we're seeing the launch of a successful launch of his rockets. We're seeing this plan coming out, and I think he's already really focused on the companies he's managing. So I can see why the board's actually voting against that proposal.
Steve, great to get some time with you. Really appreciate it. Steve Mann there of Bloomberg Intelligence. He leads our car coverage. I sometimes call him up just to shoot the S.
Cars.
Yeah, just to chat cars, He has incredible knowledge on the industry and also pretty good taste, I'd say. It's important.
Does he own a Tesla?
No, I don't believe so.
Okay, we'll leave it there. Maybe that says everything.
It's nothing he's ever admitted to me.
I see. But to your point, he is talking about Tesla. He talks about cars, but it's much more than that, Matt.
We are going to talk about cars.
Yeah, we
are. Coming up, BMW has released its Neue Klasse, the iX3.
Of course.
Mercedes has released its new electric, second-generation electric car, the GLC. The CEO of Mercedes told me and Hannah Elliott on my Hot Pursuit podcast that he's going to release a convertible G-Wagon, and SparkCharge CEO Josh Aviv is going to join us to talk about his company expanding its giant, already large EV charging network.
It will start below 70,000 euros. There will be a 6 in front of it. So the pricing will be very competitive. The price is achievable. And if you compare that to the content of the car, this is extremely competitive.
That was BMW CEO Oliver Zipse talking with Bloomberg's Oliver Crook, a couple of Olivers there. The automaker unveiling in Munich the new second-generation electric platform. The iX3 is the first vehicle on that platform, showcasing the company's most advanced hardware and software. BMW expecting EVs to contribute now more than 50% of its sales in 2030. Here with more is Bloomberg's Global Autos editor, Craig Trudell. And Craig, I guess the looks matter to some extent, but the important thing about this vehicle is more than 500 miles of range on one charge. It can charge more than 200 miles in 10 minutes. So it's leaps and bounds above other Western EVs.
Yeah, the range is really strong. The charging time is extremely competitive. And to your point on looks, I know this is a subjective thing, but they fixed the grill. You know, they don't have a bucktooth looking electric vehicle that's an SUV. That has been, you know, something that has been, you know, sort of the source of mockery. I think that the vehicle looks different inside and out. And this is a company that has bet a ton of money, you know, more than 10 billion euros toward this Neue Klasse line of vehicles. And it's going to change over its lineup extremely quickly. So this is really the start of a story that we're going to be talking about for the next couple of years.
Did they fix the grill? Greg, Matt, I'm looking at you can't tell me this thing doesn't look, show the picture. You can't tell me this thing doesn't look like a snapping turtle. It's crazy looking. I don't think this looks good.
It's more kidney-like.
Right? It looks like
a little bit more traditional. Actually, I think it doesn't look like that much of a difference. To me, it looks still like an iX3. The real difference is in the concept that they have, the Neue Klasse. That's like their 3 Series concept, which I hated at first, and I've been talking to our autos reporter, Will Wilkes in Frankfurt, and I'm liking it more and more. It's bringing back 2002 vibes, but this is just like, a grocery getter. Can anyone else match this technology right now, Craig? I mean, without putting in, you know, a 250 kilowatt hour battery, can anybody else outside of China do 500-mile range?
I think the answer to that actually lies with the battery suppliers, and, you know, is there some differentiating technology that a manufacturer like BMW can bring to the table? Absolutely. But for the most part, you know, these cell suppliers now are kind of calling the shots for this industry. So a company like CATL is, you know, what everybody is counting on for these performance metrics. And it is going to be the case that you're going to have to sort of differentiate in other ways. That being said, I think BMW absolutely, you know, is doing the things that they need to do with CATL cells to achieve these metrics, and it is, you know, something that even in China I think will be competitive. Will it be much higher price than a lot of other electric vehicles in China? I think that will still be the case, and that may cap their potential in that market because things are still just extremely cutthroat in China.
All right, Craig, thanks very much for joining us. Craig Trudell, there, our global autos czar. He's covered vehicles for us out of Detroit, out of Tokyo, and now in London. Check out his Hyperdrive column, especially focused on the future of automobiles. Staying in the world of EVs, we've got another expert with us here on set. SparkCharge is the world's largest mobile electric vehicle charging service provider, raising over $30 million in new funding. The money will help expand its mobile EV chargers across North America. Mobile EV chargers, note. Here with us is the founder and CEO, Josh Aviv, who also happens to be somewhat of an EV expert. Josh, let me first get your take on this BMW technology. I know Mercedes has a new one out, the GLC, and we're starting to get into a world where range anxiety shouldn't be that much of an issue.
Yeah, I agree. I mean, I think what BMW did is amazing, right? And I think you asked a good question. Is there anyone else out there with a 500-plus mile vehicle? The Cadillac IQ, very big vehicle, but I think some people have started to see up to 600 miles when they're hypermiling. So I think a lot of consumers are going to like that, right? I think a lot of consumers are going to push beyond this 250 to 300 mile range and start to see 500 miles. And I think that's great for the industry.
I have driven, just for the record, the Cadillac Escalade IQ.
Yep.
And I did enjoy it.
Yes.
It is a land yacht.
Yes.
Of largest proportions. I think it has a 200-plus kilowatt-hour battery.
205 kilowatt-hour battery.
Okay, but doesn't this all beg the question, if all of a sudden you don't have that range anxiety anymore, if you can drive this BMW for hundreds of miles and not worry about it, how does that change your business? Because you're also trying to address range anxiety.
Absolutely. So for us, it's a great thing, right? We like to see cars with bigger batteries. Bigger batteries mean more charging, right? And so I think that's great for everyone in the industry. It's a win-win-win. Consumers can drive longer. EV charging station companies like ourselves are able to fuel them quicker and give them more energy. So we love it.
Your big business isn't fleet. You're not going to be charging up Dani in her BMW iX3, right?
Although I'm sure if I called you up, you'd help me out. But
well, actually, I think that's a great question, right? Yeah. Will we start to see rental car companies adopt these and put them into their fleets because they have longer range, right? I think that's a very, very good value proposition for companies like Hertz and Avis. Hey, we've got a car that's 500 miles. You might not need to charge it on your weekend rental. Just bring it back.
By the way, does the battery chemistry changes that we see in automotive, Does that come to SparkCharge also? Do you have to constantly be keeping up with the top chemistry?
We are battery agnostic in our technology, and we designed it to be that way so that we could always take advantage of the best battery technology out there. If we have a more denser, lighter battery pack, then we can deploy more energy on a single go.
Just how capital intensive is that? Matt mentioned that you raised $30 million in May. Congratulations. What is that going towards?
Absolutely. It's going towards expansion. So we're happy to announce we're available in all 50 states across the United States. And we just expanded into Canada and Mexico. So we are now covering almost all of North America. And we plan to expand into Europe and the Middle East, hopefully in the next couple of months.
So your charging network is mobile. That means you meet the customer where it is.
Yes, sir.
What do you think about the advance or lack thereof that's been made in the fixed charging infrastructure? Because that's one of the biggest complaints. I talked to Ola Kalenius a couple of days ago, and he says he thinks they're doing not a great job in most European countries. Here it seems a little bit better, but what's your take on that?
Absolutely. So I think...
And as an EV driver yourself, right?
As an EV driver, I think we're going through multiple different phases of, like, call it infrastructure in the United States. If you remember when infrastructure first came out, 50 kilowatts, 50 kW was like super fast. Everyone was excited. Then we started to see 200 and 350 kW come out, and that allowed people to charge quicker, get on the road, travel further. I think we're starting to enter what we call the third phase of infrastructure in the United States, where we're starting to see 400 kW charging stations that can charge cars in a matter of minutes. And I think the fourth stage will be that holy grail, that 1,000 kilowatt charging station, or what we call megawatt charging. I think once we see that, that'll be, call it the fourth and almost final stage, where now it's just about as quick as putting gas in your car. You can charge your EV just as fast. And I think adoption will grow much faster after that as well.
But you mentioned all the geographies you're expanding into, but within those geographies, how does it change based on whether it's an urban area, suburban, more rural? Does the strategy need to change of where those are placed and how much investment you're putting into it?
Absolutely. From the SparkCharge side?
Yes.
From the SparkCharge side with fleets, if it's a fleet in a more rural area, it really means that basically they're servicing, for example, a lot of consumers that are a lot further out. So you're talking about an Amazon, you're talking about a rideshare company or something like that that wants to basically service consumers in an area that there is no infrastructure. When we're servicing fleets that are in more dense cities and more urban environments, then what we're seeing is that they're typically needing quicker charges. So it's really a quick go because they want to turn the vehicles quicker. It's not so much long distance, but speed to get the vehicle back out on the road. So we typically deploy faster charges in those urban environments.
I have a bit of a wonky question because I've been driving this Rivian R1S this week, which the design is fantastic, but it's still on the 400-volt architecture. And I don't know why they chose to stay there. It's like using a tiny little hose, right, to try and get water out of. Is everybody else moving to 800 volt? And then what's the next step?
I think most car companies are going to move to 800 volt, but I think because a lot of the charging stations that we have deployed today work on 400 volt, I think what you'll see is like this interim. Like, for example, the Hummer can do both. So the GM Hummer can do both 800 volt charging and 400 volt charging.
So can the Ioniq,
and the Ioniq.
Yeah.
And I think that's the right way to go so that you don't leave any of the legacy systems out.
All right.
By the way, I like how you said that question was wonky, as if all the other ones you asked weren't wonky car questions, too.
It's rare that I get to talk with someone who knows so much about cars here on set, and I appreciate it as well. Look forward to having you on my podcast on Hot Pursuit. Josh Aviv there is the founder and CEO of SparkCharge. It is the largest mobile charging network in the world.
Time to get a little teaser of this week's Wall Street Week. From high-speed trades to household savers, India's markets are evolving. David Weston dives into the country's regulatory tightrope as retail money pours in and IPOs surge.
As a market maker with a unique model, Jane Street's business makes bets on inefficiencies in markets. Bloomberg reporter Catherine Doherty has been reporting on its business in India.
Jane Street has kept its trading secrets close to their chest, but it was really the Millennium lawsuit.
Jane Street saw an opportunity in India's equity markets, engaging in a strategy called index arbitrage.
So the firm was essentially placing these large bets that were then impacting the other side, and they were profiting from the way that these markets were moving. So the regulators in India have identified this as a manipulative trade, and the firm has said it was an arbitrage trade and not market manipulation.
India's market regulator, the Securities and Exchange Board of India, or SEBI, banned Jane Street from the country's securities markets. Jane Street has filed an appeal alleging that SEBI denied it access to documents it needs to defend against market manipulation accusations. Ironically, the problem with India's capital markets historically has not been encouraging too much risk, but too little. Nilesh Shah has watched the evolution of the country's capital markets as the managing director of Kotak Mahindra Asset Management.
The Indian savings allocation is more tilted towards physical assets. We are one of the largest buyers of gold in the world, putting anywhere between $50 to $70 billion annually. We also have love for real estate. Capital market or financial savings itself has taken off in recent times. But thanks to mutual funds, insurance industry and pension funds, slowly and steadily, allocation to capital markets, both debt and equity, is increasing rapidly.
India's transition to retail investing is still in its early stages, but it is moving fast. 1 in 5 households today hold shares, up from 1 in 14 just 5 years ago.
We launched an investor awareness program called Mutual Funds Sahi Hai. Mutual funds are right thing to do. And that has helped us in mobilizing more and more retail savings into mutual fund. Our industry is growing at a frenetic pace, and I believe the nudges from the regulator, the work done by the regulator, is laying the foundation. Now it is up to us as an industry to carry forward the work.
One measure of the expansion of Indian capital markets is the success of its IPO market, which is among the biggest in the world.
Last year, IPOs in India accounted for about more than $20 billion US dollars. It was the number 2 IPO market in the entire world.
That was David Weston on India's capital markets. You can catch Wall Street Week every Friday at 6 p.m. New York time, and that means today because it is Friday. Coming up, President Trump warning chip tariffs are coming soon. We'll get the latest from Washington, D.C., and there's a lot to get. This is Bloomberg Open Interest.
Chips and semiconductors, and we'll be putting tariffs on companies that aren't coming in. We'll be putting a tariff very shortly. You probably are hearing we'll be putting a fairly substantial tariff on, not that high, but fairly substantial tariff, with the understanding that if they come into the country, if they're coming in, building, planning to come in, there will not be a tariff.
President Trump saying his administration will announce chip tariffs soon, speaking at a White House dinner with big tech CEOs. Bloomberg Washington correspondent Tyler Kendall joins us now. And among those at that dinner, Tyler, was Tim Cook, which Trump went on to say Tim Cook would be in pretty good shape. So what form do we expect these tariffs to take, and who gets relieved from them?
Yeah, hey, Dani. Well, I actually just had the chance to catch up with the NEC director, Kevin Hassett, here at the White House, and I posed a very similar question to him about what it's going to look like when it comes to these reprieves, and he said that those details are, of course, still being worked out. But we've been able to glean some clues from President Trump himself, appearing to reaffirm last night that those companies that commit to onshoring production, investing in the United States, will be able to get some sort of leniency when it comes to these levies. One of the big questions here is, one, what's the rate actually going to be? President Trump has floated tariffs as high as 300%, but at the same time, he's also brought that down to 100%. You heard him right there outlining that it's going to be substantial, but not too high. And then when are they going to actually come? I pressed the NEC director on this. He said that that Section 232 investigation has been making progress and that he expects to have something to present to President Trump in the next few weeks or sooner. In his words, it's going to be something that we're watching very closely because we know the White House is working on what's considered to be a rather expedited timeline when it comes to Section 232 investigations. This one was launched back in April into, of course, the entire supply chain, Dani, not just chips themselves, but the equipment used to make the chips. And then, of course, importantly, those downstream products like consumer electronics.
Speaking of tariffs, Tyler, there are a lot of lawsuits out there. What do we know? What's the latest on the federal appeals court decision that is pushing the White House to the Supreme Court?
Well, when it comes to the tariffs, we know that the White House has already put forward and they're asking for an expedited ruling here. They want the Supreme Court to start to hear arguments in early November. That could potentially open the door, Matt, for a ruling by the end of the year. Important to note, though, that the Supreme Court's term goes into the middle of next year. So this by no means is a sure thing. But it's clear that this White House wants to see this done as soon as possible. In fact, in their filing to the court, they cited how this appeals court ruling is complicating their ongoing negotiations. Of course, the other side of this is that we know that trillions of dollars are tied up in this decision. I had spoken about this the other day, but I was really struck by the Committee for a Responsible Federal Budget, which put out that if the Supreme Court upholds this ruling, it could potentially vanish about 71% of the projected tariff revenue. It's something that we're watching really closely here, and something that, again, the NEC director Kevin Hassett told us reporters here at the White House earlier today they are confident in their arguments.
Tyler, thank you very much for bringing us the latest. That is Bloomberg's Tyler Kendall. Now, we did about 2.5 hours ago get labor market data that showed the slowest 3-month job growth now since COVID. Initially, stocks rallied, but they are turning around now. We asked Julia Coronado of MacroPolicy Perspectives about that initial market reaction.
We've got this strange dichotomy of a stock market. I mean, for a macroeconomist to watch a stock market rally off of this report, it's just not the way I construct the engine of growth.
Matt, we got to give credit to Julia because we did see a market now turn down 0.5% after that labor market data.
Yeah, right. And we were up about that much when we started talking to her. So I'm not sure if it's a call, but her logic seems to be more aligned with what the market is looking at right now. You can see, as Dani said, we're off 0.5%. We had been above, well above 6,500, so another new record. And we still see yields much lower, right? As soon as this decision came out, we saw the 2-year yield drop to what, the lowest level since 2022? Mm-hmm. And we were down all across the curve, still are down all across the curve right now. Even on the long end, the 30-year down by 1.1 basis points to 47.89.
Yeah, it's important that move is sticking because what it implies is that this is a data that's maybe bad enough for 25 or even 50, and it's not for the right reason. So can growth really hold up? Can stock gains continue to hold it as well?
That is the debate. Coming up on Monday, Citi's Stuart Kaiser will weigh in. We also have Katrina Dudley of Franklin Templeton and Carlyle's Chris Pareo, plus CEOs from TickPick on sports and Ethan Allen on couches. This is Bloomberg Open Interest.